on superannuation. And so when we're talking about self-managed super funds, as you see there towards the bottom of that slide, there's tax-free super earnings in retirement phase. So what I mean here is that when in super, you're earning income, profits, gains, and that superannuation is paying out a retirement stream to you. So you got to your older age and you're starting to draw down super, the earnings on that can be tax-free. They won't necessarily have to pay any tax. You might have to pay 10 or 15% tax, but they could be tax-free. Depends on, obviously, the super laws at that time when you're taking them out. But in this current climate, if you've got less than 1.6 million that's been put in to support that retirement stream, you're basically looking at whatever earnings are in there, completely tax-free. That means you might be lucky enough, you might earn some crypto in there, and it might go from 100 grand, it might go to 10 million. That growth in the right conditions, completely tax-free. So incredibly great environment to have. So the big downside of superannuation or structuring it that way would be your access to super monies. If you're not anywhere near retirement age, you can't touch and use those profits for your personal use until you get to retirement. So that's a disincentive to put the money in there. If you wanted to use the gains for something else before you hit retirement. But if you're looking to invest in cryptocurrency and you think they're going to help part of your longer term retirement planning, superannuation can be very attractive because of those lower tax rates. And we're also talking about super, we're also talking about contributions and their ability to reduce our personal taxable income and therefore personal tax rate. So what you can do is you can contribute monies to superannuation and get a tax deduction for it. Why would you do that? Because that can reduce your overall tax rate. So contributing to super, or contribution that goes into super that is deductible to you would be ordinarily taxed at 15% in the super. If you're a higher income earner, say earning over $200,000, I think the limit is at the moment, it might be 250. I can't quite recall at this time, somewhere within 200 or 250,000. If you're earning over that amount, that contribution action might be effectively taxed at 30%. But still, there is benefit. The benefit would be that the amount that you contribute in there, that's within certain thresholds. So there's certain thresholds that you can do. So you can't just contribute as much as you want into super. So you have to be very mindful of the contribution caps. But the amount you contribute goes as a tax deduction in your tax return. So if you're going to pay 39 cents for each dollar of profit, 49 cents on each dollar of profit, now each dollar that you put into super is saving you the difference between your tax rate and the super tax rate. So if your tax rate was 47 cents on the dollar and going into super, you're only paying 15 cents, you're basically saving 32 cents on the dollar each dollar contributed to super. If your tax rate was 30% going into super, you save 17 cents. If your tax rate was 39 cents on the dollar and whatever your super contribution was being taxed at 30%, you're still saving 9 cents on the dollar. So you are saving, making those contributions. But it's really important, there are contribution caps going into super, and that some of those caps might have already been soaked up, are used up by, say, your employer making contributions on your behalf. So you might only have a small amount available. But at this time, we now have availability of catch-up contributions. If in previous tax years you didn't fully utilise your cap, those unused amounts can flow over. I believe the rule is up to 5 years, starting about 3 years ago. They can add on top, and then all of a sudden, instead of that year's cap, you might have had 10 grand available. If you had 10 grand available that you didn't use up for the last 3 years, the actual total cap you can use is now 40 grand. So you can make a slightly larger contribution. You might want to consider using that to get that tax savings. There is also another strategy to give a little bump up to the amount you can contribute as well. It's called a reserving strategy. That's a very unique one, a very complex one. You want to definitely get advice and assistance with this. But essentially, it allows you to use next year's contribution, so the amount that you're not going to use next year, to bring it into this year. You would need a self-managed super fund to do this, and you've got to be very careful around how much you're going to use in this reserving strategy, because if you're making a contribution now and then next year you make more than you otherwise were planning to, you might breach the cap next year, which could have some serious implications. So when it comes to all this, wrapping it all up, and we're talking about self-managed super funds, look, highly regulated. A lot of onus is on you to abide by the super laws and tax laws there. These funds are audited, so essentially your accounting costs go up quite substantially. You've got audit costs involved. So ordinarily, the rule of thumb is, at the very least, $200,000 in super to make them cost effective. This day and age, you even hear PASIC talking about a higher amount. Yes, you can set them up if you have a lower amount in super, but you've got to look at that cost and benefit analysis. And I really do suggest that you seek out professional help with setting these up, or at least considering setting these up. And if you'd like to explore that, Fundraise can assist with that process.